Breaking news. U.S. forces have launched retaliatory strikes in the Middle East.
All units, missiles are away. Seek cover immediately.
Everyone's talking about Iran right now. Missiles. Escalation. World War III trending on Twitter. Nobody's talking about what this actually means for your bank account. Here's the reality. Geopolitical chaos doesn't just affect headlines. It affects gas prices, stock markets, inflation, and your portfolio. Whether you've got $5,000 invested or $500,000, this matters. I'm going to break down exactly what's happening to your money right now, what history tells us happens next, and the 3 moves you should actually make. Let's go. The first thing that happens when Iran gets mentioned in the same sentence as military conflict? Oil prices spike. Why? Because roughly 20% of the world's oil passes through the Strait of Hormuz. Iran controls one side of it. If that strait gets disrupted, through blockades, attacks, or even the threat of conflict, oil supply tightens immediately. And when oil supply tightens, prices go up. Fast. We've seen this before. In 2019, when Iranian-backed forces attacked Saudi oil facilities, oil prices jumped 15% overnight. Not because supply actually stopped, just because the market feared it might. Right now, oil is already reacting. Brent crude jumped nearly 4% in the first 48 hours after the latest escalation. West Texas Intermediate followed. That translates directly to gas prices at the pump within days. If you're driving, you're paying more. If you're ordering anything that gets shipped, you're paying more. If you buy groceries, you're paying more. Because fuel costs ripple through everything. Here's the math. A $10 increase in oil per barrel adds roughly 25 cents to gas prices. Doesn't sound like much until you realize the average American uses about 500 gallons of gas a year. That's an extra $125 annually just from one $10 spike. But it's not just gas. Energy costs feed into inflation everywhere. Shipping costs rise. Manufacturing costs rise. Food prices rise because tractors and transport both run on fuel. The Federal Reserve watches this closely. If inflation spikes because of energy, they might delay rate cuts or even consider hikes again. That affects mortgage rates, credit card rates, car loans, everything. So yes, missiles in the Middle East absolutely touch your wallet. Immediately. The stock market hates uncertainty, and war is peak uncertainty. When Iran tensions escalate, you'll see immediate reactions. Defense stocks like Lockheed Martin, Raytheon, Northrop Grumman, they go up. Sometimes 5% to 10% in a single day. Everything else? Usually red. Tech stocks drop because uncertainty makes investors risk-averse. Consumer discretionary drops because people tighten spending during fear. Airlines drop hard because fuel costs spike and travel demand falls. The S&P 500 typically dips 2% to 5% in the initial days of a geopolitical shock. Volatility spikes. The VIX, the fear index, jumps. People panic. Here's what you need to understand. This is normal. This always happens. And it almost always reverses. Let me show you the data. When the US launched airstrikes on Iranian General Soleimani in January 2020, the S&P dropped 1.2% immediately. Within 2 weeks, it was back to all-time highs. Gulf War in 1991, market dropped 17% in the lead-up. Recovered fully within 6 months and then climbed another 20% that year. Iraq War in 2003, initial volatility. Then the market went up 26% over the next 12 months. The pattern is consistent. Initial fear, sharp drop. Then recovery as people realize wars don't end economies. Now here's the trap. This is the moment where amateur investors panic sell. They see red, they think it's going to get worse, they pull everything out, and they lock in losses right before the recovery. Professional investors? They're buying during the dip because they know this playbook. Warren Buffett has a famous quote, "Be fearful when others are greedy, and greedy when others are fearful." This is the fearful moment. That doesn't mean go all in on risky bets. It means if you are already investing regularly, don't stop now. The worst financial move you can make during geopolitical chaos is emotional decision-making based on cable news fear. Let's talk about the things people do right now that destroy their wealth. Number 1. Panic selling everything. You see your portfolio down 5%. You convince yourself it's going to zero. You sell. The market recovers 2 weeks later. You miss the rebound and locked in permanent losses. Don't do this. Number 2. Going all in on gold or crypto as a hedge. Yes, gold often rises during uncertainty. Yes, some people call Bitcoin digital gold. But if you're not already diversified into these, Now is not the time to dump your entire portfolio into them hoping for safety. Gold spiked to $2,700 an ounce recently, but it's volatile. It crashed 30% in 2013. It went sideways for a decade after 2011. It's not a guaranteed safe haven, it's just another asset class. Crypto? Even worse. Bitcoin can drop 20% in a day regardless of geopolitics. Using war fear to justify a crypto gamble is not a strategy. It's panic disguised as action. Number 3. Trying to time the market. Thinking you'll sell now, wait for the bottom, then buy back in. Nobody, and I mean nobody, can time the bottom. You'll sell. Watch it drop another 3%. Feel smart. Then watch it rip back up 10% while you're still sitting in cash trying to decide when to re-enter. Market timing doesn't work, especially during chaos. Number 4. Stopping your automatic investments. If you've been dollar cost averaging into index funds every month, this is the worst time to stop. You're now buying shares at a discount. That's the whole point of automatic investing. You buy more shares when prices are low. The people who kept investing through 2008, 2020, every crisis, they're the ones who built wealth. The people who stopped and waited for safety missed the recovery entirely. Stay calm. Stay consistent. Do not let cable news dictate your financial decisions. Here's what every war, conflict, and geopolitical crisis in modern history teaches us about markets. Short-term volatility is guaranteed. Long-term growth is overwhelmingly likely. Let's go through the data. World War II. The market dropped during Pearl Harbor. Then it climbed 130% from 1942 to 1945, while the war was still happening. Korean War. Market dipped initially, ended the decade up massively. Vietnam War. Lasted over a decade. The market still grew. Gulf War. 17% drop leading up to it. Recovered within months. Up 26% the following year. 9/11. Market closed for days. Dropped 14% when it reopened. Recovered every dollar within 6 weeks. Iraq War 2003. Initial fear. Then one of the strongest bull runs in history. 2020 COVID pandemic. Market dropped 34% in a month. Recovered to all-time highs within 5 months. Kept climbing. The pattern is undeniable. Shock, fear, drop, recovery, growth. The S&P 500 has survived 2 world wars, multiple regional conflicts, terrorist attacks, pandemics, financial crises, and political chaos. And over the last 100 years, it's averaged 10% annual returns. Every single crisis felt like the end at the time. None of them were. Now, does this mean the Iran situation won't escalate? No. Does it mean markets won't drop further in the short term? No. It means that betting against the long-term resilience of the global economy has been a losing bet for over a century. And unless you genuinely believe this specific conflict ends capitalism and modern civilization, which would make your stock portfolio the least of your concerns, the correct move is to stay invested. History doesn't guarantee the future, but it rhymes, and the rhyme says, stay the course. All right, here's what you actually do. Move 1. Make sure you have an emergency fund. 3 to 6 months of expenses in cash. Not invested, not in crypto. Cash in a high-yield savings account earning 4% to 5%. If geopolitical chaos turns into economic chaos, your emergency fund is what keeps you from being forced to sell investments at the worst possible time. Move 2. If you're already investing regularly, keep going. Do not stop your automatic contributions. You're buying shares on sale right now. This is how wealth is built. Consistency during volatility. If you're not investing yet, this is not the time to go all in trying to time the bottom. Start small. Automate. Stay consistent. Move 3. Rebalance if you're way off target, but don't overreact. If your portfolio was supposed to be 80% stocks, 20% bonds, and it's now 75% stocks because of the dip. Fine, rebalance. But don't go 50% cash because you're scared. Stick to your plan. That's it. 3 moves. Emergency fund, keep investing. Rebalance if needed. No panic, no crypto gambling, no trying to outsmart the market. Just calm, boring, historically proven strategy. So that's the reality. War fears spike oil, shake markets, and test your nerves. History says stay calm and stay invested. If this helped, subscribe. I break down money and markets every single week without the BS. Drop a comment. Are you staying invested or sitting in cash right now? I want to see where people actually are. Stay informed. Stay rational. See you in the next one.